Every trader has heard of Dow Theory. Higher highs, higher lows, trend is your friend. You learned it early. You drew the lines, you waited for the breakout, and then price reversed in your face. Again and again, and you walked away thinking Dow Theory doesn't work. Here's what actually happened. Someone taught you Dow Theory as geometry. Draw lines, connect dots, wait for price to break through. But that is not what Charles Dow observed over 130 years ago. He wasn't drawing lines on a chart, he was reading psychology. The psychology of who is buying, who is selling, and why the crowd behaves the way it always has. And that single distinction, geometry versus psychology, is exactly why 95% of traders fail with this theory, while the remaining 5% use it to read the market at a level most retail traders never reach. Not financial advice, just education. Let's get into it. Before we go into the mechanics, here is something most traders don't know. Charles Dow, the father of technical analysis, never wrote a single trading book. Everything we call Dow theory today came from editorials he wrote for the Wall Street Journal in the late 1800s. After his death, two men, S.A. Nelson and William Hamilton, compiled those observations into 6 core principles. Those 6 principles became the foundation of everything we now call technical analysis. Every concept you use today, market structure, trend following, swing points, all of it traces back to what one man observed in newspapers over a century ago. And yet 95% of traders who claim to use his theory are using a simplified, distorted version that misses the entire point of what he actually wrote. By the end of this video, you will know how to read market structure the way Dow actually intended. You will know exactly where you are inside any trend's life cycle at any given moment, and you will know with precision when a trend is actually reversing versus when the market is simply setting a trap. 3 pillars. 1 complete system. Let's start building it from the ground up. Pillar 1. The anatomy of trends, and why almost everyone gets this wrong from the beginning. Imagine you are standing on a beach watching the ocean. You see 3 things happening simultaneously. The tide is slowly coming in. Powerful, directional, hours long. That is the strongest force in the water. On top of the tide, you see waves, rising and falling, but always broadly following the tide's direction. And on top of each wave, you see ripples, small, fast, unpredictable, random looking. Dow divided every market into exactly these 3 layers. The primary trend is the tide. This is the big picture. Months to years. Is the market broadly going up or broadly going down? You determine this on the weekly and daily charts by reading the overall pattern of swing highs and swing lows. Higher highs and higher lows equal a bullish primary trend. Lower highs and lower lows equal a bearish primary trend. This is your compass. Everything you do as a trader must be oriented against this layer first. The secondary reaction is the wave. Weeks to months. This is the counter-trend pullback that happens within the primary trend. The correction, the retracement. Dow observed that secondary reactions typically retrace between 33 and 66% of the previous primary move. And this, pay close attention to this, is where smart money reloads their positions. Every major pullback within a primary uptrend is an institution accumulating more at better prices before the trend continues. Understanding this changes how you see corrections forever. The minor trend is the ripple, hours to days. Dow himself was explicit about this. Minor trends are noise. They are unpredictable by design. And in today's markets, that noise has been amplified many times over by high-frequency trading algorithms that specifically create false signals at the minor trend level to trigger retail stop losses and generate order flow for institutions. And here is mistake number 1. If you are applying Dow theory on a 5-minute chart, you are not reading the market. You are reading manufactured noise. Dow warned against this himself. The rule is simple: anchor your Dow analysis to the 4-hour, daily, and weekly charts. That is where structure is real. Everything below is fog. Now here is a detail that changes everything about how you identify swing points. Dow theory emphasizes the closing price, not the wick. A swing high is not simply any peak that appears on your chart. A valid swing high is a point where the candles before it closed lower and the candles after it closed lower. Closes, not wicks, on both sides. The same logic applies to swing lows, and this matters enormously because wicks lie. A wick can spike above a previous high and close back below it. That is not a new high. That is a liquidity sweep where institutions triggered retail stops to fill their orders. But a candle that closes above a previous swing high, that is a genuine structural change. Dow theory is built entirely around closing prices. Once you understand this, you will stop being fooled by wick-based false breakouts that the market uses to trap retail traders daily. Now with valid swing points identified, here is how structure actually works in practice. In an uptrend, each pullback holds above the previous swing low. That is the defining feature of a healthy uptrend. Not just higher highs, higher lows. The moment price closes below a previous significant swing low, the structure of the uptrend has been compromised. In a downtrend, each rally fails below the previous swing high. Lower highs and lower lows. The moment price closes above a previous significant swing high, the bearish structure is broken. And here is mistake number 2, probably the most expensive one retail traders make. Confusing internal structure breaks with primary structure breaks. On any chart, there are primary swings, the large obvious turning points that define the major trend. And there are minor swings, the small pullbacks within each impulse move. If you treat every minor swing low as a critical structure point, you will be whipsawed constantly. Stopped out of good trades on normal corrections because you mistook minor noise for primary trend changes. Not every dip is a trend change. Not every bounce is a new trend beginning. The rule is always identify which tier of structure the swing point belongs to before you make any decision based on it. Pillar 2. The life cycle of every trend, and how knowing your location changes everything. Every major trend moves through 3 psychological phases. Not 2, not 4, 3. And knowing which phase the market is in right now changes everything about how you should be positioned. Phase 1 is accumulation. The market has been declining for months. News is terrible. Retail traders are panic selling or have completely abandoned the asset. Everyone has given up. But behind the scenes, institutional money, funds, smart money, they are quietly buying. They cannot buy everything at once because their order sizes are enormous. If they bought aggressively in a thin market, they would push price against themselves before they finish building their position. So they buy gradually, day after day, absorbing retail's panic selling within a tight sideways range. What does this look like on your chart? A boring, tight, directionless range after a prolonged decline. Volume is low. Nothing exciting is happening, and occasionally price dips below the range, stops get triggered, panic increases, and then price comes right back inside. That is not random. That is by design. Institutions need sellers to sell to, and retail stop losses create exactly the sellers they need at exactly the prices they want. Phase 2 is public participation. This is the main event. Supply dries up because institutions have absorbed the majority of available selling. Price breaks out of the accumulation range with genuine momentum. News starts turning positive. Trend followers begin to recognize the move. More participants join. On the chart, this is what you want to see. Large candles, clear directional movement, expanding volume on the impulse legs, contracting volume on the pullbacks. This is the longest phase and the strongest phase. This is where the majority of the move happens and where money is consistently made by traders aligned with the trend. Phase 3 is distribution. News is now euphoric. Headlines are calling for much higher prices. Social media is full of people showing their profits. Your colleagues are talking about the trade. The taxi driver has an opinion. And at exactly this moment, smart money is selling. Quietly. Using the wall of retail FOMO buy orders to offload their massive accumulated positions at the highest possible prices. Price might push to new highs during distribution, but look closely. The gains are getting smaller, volume is high, but the candles are choppy and conflicting. Something feels off even while the news says everything is fine. Mistake number 3, the one that destroys the most accounts in the most painful way. Buying aggressively during phase 3 because you mistook it for phase 2. The chart looked great, the move looked strong, and then it reversed because you were late. The rule is always ask yourself where this asset has been before deciding where it is going. If it has been trending strongly for months and news is overwhelmingly positive and everyone around you is positioned long, the most honest question you can ask yourself is simply, am I early or am I late? And here is mistake number 4. Subtle but important. Accumulation and distribution look almost identical on a chart. Both are sideways ranges. Both have fakeouts below and above. Both have sweeps of obvious levels. The difference is context. A sideways range that appears after a prolonged downtrend is probably accumulation. Smart money building positions after a decline. A sideways range that appears after a prolonged uptrend is probably distribution, smart money offloading positions into retail demand. Context is everything. The same pattern means opposite things depending on what came before it. Pillar 3, the death of a trend, and how to tell the difference between a real reversal and a trap. This is the question that separates profitable traders from everyone else. When does a trend actually die? Dow's principle is straightforward. A trend persists until there is clear evidence of reversal. But what counts as clear evidence? This is where most traders get destroyed. In an uptrend, the trend is alive as long as price keeps making higher swing lows. The trend is dead when price breaks below the most recent significant swing low with a candle close, not a wick, followed by confirmation in the subsequent candle. This sounds simple, but how the break happens matters as much as whether it happens. There are 3 scenarios when price approaches a previous swing low. Scenario 1. Price wicks below the swing low and closes back above it. This is not a break. This is a liquidity sweep. Institutions pushed price below support specifically to trigger retail stop losses and create the sell orders they needed to fill their buy orders at better prices. The wick went down, the close held. Structure is intact, the uptrend continues. Scenario 2. Price closes below the swing low, but the very next candle reverses back above immediately. This is suspicious. Be patient. Wait for more information. Scenario 3. Price closes below the swing low with a strong full-bodied candle. Minimal wick, large body, decisive. And the next candle continues in the same direction, not immediately reversing. That is a genuine structure break. That is your clear evidence of reversal. Mistake number 5. Treating a wick-based sweep as a trend reversal. Price drops below a key low, you panic, you exit or reverse your position. Price immediately shoots back up without you. This is one of the most common and most expensive experiences in retail trading, and it happens because institutions specifically engineer it to happen. They need your stop-loss order to fill their buy orders, they push price below support to trigger your stop, and generate the sell orders they need. Once those stops are cleared, price recovers immediately. Dow described this mechanic over a century ago. Modern smart money concepts simply gave it a name, and one critical filter before acting on any structure break. Which time frame did this break occur on? If a swing low broke on the 1-hour chart but the daily swing lows are still completely intact, the primary trend has not changed. You are looking at a minor structure break, which is noise. Not a primary structure break, which is signal. Always confirm that the break happened on the primary time frame before changing your directional bias. The warning signs. Reading weakness before the reversal. Before a trend dies, it weakens, and that weakness leaves specific, readable fingerprints on the chart. 3 warning signs that tell you the trend is losing strength before the actual reversal occurs. Warning sign 1. Diminishing impulse legs. Compare 3 consecutive moves in the trend direction. If the first move was large and powerful, the second was shorter, and the third barely moved at all, the trend is running out of energy, like a runner whose strides are getting shorter and shorter just before they stop. The trend is not dead yet, but it is visibly tiring. Warning sign 2. Deeper corrections. In a healthy uptrend, pullbacks are typically shallow, 30 to 40% of the previous impulse. The buyers are so eager that they step in quickly and don't let price retrace very far. But when corrections start getting deeper, 50%, then 60%, then 70% retracements, the buyers are losing urgency. They are waiting for lower prices before entering. The sellers are becoming more aggressive. Control is gradually shifting from buyers to sellers before any structural break has occurred. Warning sign 3. Failed breakouts. Price pushes above a previous high and then immediately reverses. No follow-through, no displacement, just a spike and a sharp rejection back below. This is often the final warning the market gives before a full reversal. The buyers tried to extend the trend and failed. Supply at that level completely overwhelmed the buying attempt. Now this is critical. These warning signs do not tell you to reverse your position. They tell you to tighten your stop loss, reduce your position size, and stop adding to existing winners. Weakness is not reversal. A weakening trend can persist for a long time before the actual structure breaks. The trade is only over when the structure actually breaks with displacement and confirmation. Until that point, the trend is still alive. Mistake number 6. Treating weakness as reversal and exiting or reversing before the actual break. Weakening trends still trend. Only trade the reversal when structure breaks with confirmation. The 5-step framework. Dow Theory applied as a complete trading system. Now let's compress everything above into a practical framework you can apply to any chart beginning with your next trading session. Step 1. Define the primary trend. Open your weekly or daily chart. Read the swing structure. Higher highs and higher lows means your bias is bullish. You only look for long trades. Lower highs and lower lows means your bias is bearish. You only look for short trades. This single step eliminates roughly 50% of your losing trades immediately because you stop fighting the primary trend. Step 2. Identify the phase. Is the market in a tight sideways range after a prolonged decline? That is probably accumulation. Be patient. Do not chase. Are you seeing large directional candles with expanding volume and clear momentum? That is participation. This is where you trade. Has the asset been trending for months with euphoric news and everyone positioned in the same direction? That is probably distribution. Reduce exposure and tighten stops. Step 3. Wait for the secondary reaction. Never chase impulse moves. Wait for the pullback. Secondary reactions in primary trends typically retrace 33 to 66% of the previous impulse. If you use Fibonacci tools, that corresponds to the 38.2 and 61.8 levels. This is where smart money reloads. This is where your risk to reward is best. Entering into an impulse chases the worst possible price. Entering into a pullback within a primary trend gets you the best possible price with the trend working in your favor. Step 4. Confirm with context. Before entering, run through these checks. Does volume support the trend? Volume should expand on impulse legs and contract on pullbacks. Is the closing price structure intact? Has the primary swing point held on a closing basis? If volume confirms, closes hold, and structure is intact, you have alignment across every element. If any of those 3 fail, wait. Step 5. Execute with precision. Enter in the direction of the primary trend. Place your stop below the most recent significant swing low in an uptrend. Trail your stop as the trend creates new, higher swing lows. Exit when structure breaks on a closing basis with displacement. 5 steps. Define, identify, wait, confirm, execute. That is Dow Theory applied not as geometry, but as a complete, systematic, replicable approach to reading any market. Here is the mindset shift that ties all 3 pillars together. Dow Theory is not about drawing lines. It was never about drawing lines. It is about reading the psychology of a market full of human participants making decisions based on fear, greed, hope, and panic. Higher highs and higher lows tell you that buyers are more enthusiastic than sellers at every successive test. Lower highs and lower lows tell you that sellers have more conviction than buyers at every successive high. Accumulation tells you that patient, informed money is positioning before the crowd arrives. Distribution tells you that patient, informed money is exiting while the crowd is arriving. A liquidity sweep tells you that institutions needed your stop-loss order to fill their position. A genuine structure break tells you that the character of the market has fundamentally changed. When you read all of this not as lines on a chart, but as the behavior of human participants responding to price and uncertainty, Dow theory stops being a historical curiosity and becomes the most powerful framework you will ever use. 130 years old. But the psychology it describes is as current as the chart you looked at this morning. Drop a comment. What was the biggest mistake in this list that you have made with market structure? Was it trading the minor trend, mistaking distribution for accumulation, or getting trapped by a liquidity sweep that looked like a reversal? I read every single one. I'll see you in the next video. Stay disciplined.